So it's safe to say Tesla stock had a pretty good day today. But the question really is, what's coming next? And if you are an investor, that's always the next question is, what's coming next? What's going to happen to markets next? Tomorrow, we do have some data coming out tomorrow morning with building permits and Michigan consumer sentiment. Michigan consumer sentiment can be important, but in the short term, I got to be honest, looks pretty good for Tesla. Now, I think more importantly, we should discuss whether or not today's data changes my outlook on the probability of a recession versus soft landing. Meaning, does this data today give me more confidence that we are avoiding a recession, that we are going to have a soft landing? And the short answer is no. Not at all. And first off, I actually want to start with this clip from Liz Ann Saunders. She is the head of investments at Charles Schwab. And I think she says some things that you don't hear all the time. This is someone that I, see what they say on X all of the time, and she tends to provide a lot of value, and I think this clip provided a lot of value and perspective.
Strong data. Our next guest does say markets are stabilizing. She does think a 50 basis point cut in September is still justifiable. Charles Schwab chief investment strategist Liz Ann Saunders joins us this morning. Liz Ann, great to see you. I know you heard what Steve just said about that pad in there. What does the argument for 50 sound like?
Well, first of all, it may be justifiable based on how real rates have gone up. I don't think the Fed is going to do that. And I think today's data reinforces that the Fed's bias, at least at this point, is probably 25 basis points. I think the jobs report will be the next key measure. The Fed hasn't put inflation data in the rearview mirror, but they clearly have elevated the focus on the other part of their mandate, which is the labor market. So I think that could be the next potential needle mover for expectations around Fed policy. It's probably not going to be PCE, because once you have CPI and PPI in the books, you can kind of map to what PCE is going to be, and it doesn't look like that will be an outlier. So I think the labor market will hold the key.
I'm looking at something JP Morgan wrote last night. Looking at the next jobs report, they say job gains in the range of about 160 to 200 would likely erase much of the fear invoked by the July print. Something in the low 100s, though, they say would put that risk balance back into growth and deliver a larger cut. Do those numbers make sense?
They do, but I think you have to go beyond the payroll numbers. I think the innards of the jobs report are at least as important as the headlines around payrolls. Obviously, the unemployment rate, long-term unemployment, what you see in terms of wages, hours worked, the differential between the payroll survey and the household survey, and not just the print on payrolls, but what the revisions are for the prior 2 months and any additional assessment about the benchmark revisions that are coming in the first quarter of next year. So I don't think you get anywhere near the full picture if you stop the analysis just at the payroll print.
You know, it's interesting because the Global Fund Manager Survey from Bank of America shows recession risk is the number one concern of these fund managers. Given the data that we're seeing this morning, are those concerns justified?
We will get a recession at some point, but I think this cycle has been unique in the rolling nature of it, and that's something we've been talking about and writing about for a couple of years now. You had recessions in key segments of the economy concentrated in 2022, housing and manufacturing and housing related, and a lot of consumer-oriented goods. You recently saw a little bit of weakness in services, but that seems to have bounced. So I still think that that's the best way to think about this economy. That said, in terms of the launch point for the hiking cycle, and historically how many quarters it takes for that to bite and help to bring on a recession, interestingly, we're right at that point right now, 10 quarters ahead. So I don't think we're past the expiration date on things like the long and variable labs in terms of monetary policy, the weakness that we've already seen for quite some time in the leading indicators, the fact that the yield curve went from a pretty deep and long-term inversion back into positive territory. Those are historically recession triggers. You've got the SOM rule. There's a lot that's different in this cycle. That's why I think people are reticent to say, boy, it's coming, just because of the unique nature and the rolling nature of this cycle. But when corporations are telling you you that they're concerned about risk than a recession risk, and I think it's something you have to heed.
How about getting back to the market for a minute, Lizanne? You know, it's only a few weeks ago when we saw rates break down significantly. I think it was a CPI report, I forget. And then we had that great rotation that lasted all of, a couple of weeks, where everybody was talking about small caps. Is that not sustainable? And are we back to a mega cap-led market?
Well, I think there's some sustainability in the some broadening out and some money looking for opportunities down the cap spectrum. But what I think you need to do as an investor is you absolutely want to fade any of the lower quality components of what you're seeing move in an index like the Russell 2000 and lean into the higher quality. You still have about an 18 percentage point spread between the performance of the zombie companies versus the non-zombie companies within the Russell 2000, obviously in favor of the non-zombie companies. So I just think it's really dangerous to think about small caps in any kind of monolithic way. There's a huge spread up and down the quality spectrum within an index like that. And there are times where moving down the quality spectrum makes sense if you've got, that's where the leverage is to a major upturn in the economy. That often happens coming out of a recession. I just don't think we're at that point in the cycle. So the opportunities may exist, but you absolutely want to stay up in quality, profitability, high interest coverage, strong balance sheet, strong free cash flow. That's the way I would approach any continued rotation.
What I find most interesting about that clip is she actually says eventually we will go into a recession. Like, she's not in the soft landing camp like a lot of people, that eventually these things will trickle over into a broader recession. But she does also acknowledge the rolling recession, aspect of this economy, with real estate related sectors in deep recession. Now lately it's consumer discretionary that is in deep recessionary. Manufacturing is in deep recessionary territory now for like 2.5 years. She does also emphasize just how important the next jobs report will be, and I think that's safe to say, right? The next jobs report is going to be very important. We have basically one more data set of everything coming out between now and September 18th. And I think September 18th is a very important day. Now, we do have the Jackson Hole Economic Symposium, not next week, but the week after that, early in the week. That is August 24th through the 26th. This is where you're going to hear from Fed Jerome Powell. Back in 2022, the Jackson Economic Symposium got really popular because this was really the ending of the bull market or bear market rally. And that's when you ended up hitting the lows off of the Jackson Hole Economic Symposium. August, you ended up falling quite a bit more before inevitably hitting those lows and ultimately bouncing from them. Specifically, I think September 18th is going to be a very important event. Now, each and every single data point that we get from this point forward is going to fluctuate the odds of a 25 or 50 basis point cut from the Fed September 18th. Current probabilities with 5 weeks until September 18th have a 73% chance of 25 basis points and 27% chance of 50 basis points worth of cuts September 18th. And let me just give you the long story short version of this. 50 basis points is bad, 25 basis points is good, okay? If the Fed is forced to cut rates aggressive starting, September 18th, the first cut to jump out with 50 basis points, the markets are not going to like that, because the more cuts, the more presumed weakness in the economy we're going to get. The less cuts, the more slow and steady the Fed can take it, the less economic pain that we are going to, price in for the economy based on Fed policy. So if 50 basis points start to rise in probabilities, then I think that means downside for markets. As I've said for a long time now, not all Fed rate cuts are good. And as I have said for the past 2 weeks now, the only thing that really matters at this point is economic data. If economic data gets better and stays good, then stocks can do well in this environment. If the economic data gets worse, and we see troubling signs ahead for the economy, stocks can have large and material downside from current levels. We have to remember that from an EPS growth rate perspective, we are expecting 15% EPS growth for 2025. Okay, not this year, 2025. So forward 12-month earnings expectations are still at the highest levels they have ever been at. Okay, you are priced for perfection. You are not priced for a slowing economy. You are not priced for a recessionary economy. And that's why each and every piece of data from this point on, really over the next 3 to 6 months, is going to be heavily scrutinized, whether it's good or bad. And I do think this period of extreme volatility is likely here to stay. Now, in a good sign for the bulls, if you just draw one of these short-term trend lines here, you have 3 peaks: the all-time high right here on August 1st and what you seen yesterday on August 14th. It created a pretty, nice downward trend based on the data we got today with initial jobless claims, retail sales, and Walmart earnings. That actually allowed markets to gap up. I think this is a pretty good sign that we actually can see more upside in the near term. But I think the volatility is here to stay. I don't think there is much upside left. To go back to all-time highs, that would be upside of about 2.4% or so. Is that possible? Of course, anything's possible. I just see the risk here as maybe we trade sideways in a very volatile way until we get bigger data. Now, tomorrow morning, we will get Michigan consumer sentiment data, but that just tends to be a knee-jerk reaction at 10 o'clock in the morning when that data comes out. And then it really doesn't tend to move markets over the coming, days or weeks. It's not CPI. It's even retail sales doesn't tend to move markets for a long time, but it's just not that long lasting or too important. But nonetheless, it can move markets quite a bit when it does come out. For the headline number, we're actually expecting it will get better from 66.4 last month to 66.7. 5-year inflation expectations are expected to remain the same at 3%. And 1-year inflation expectations are expected to remain steady as well at 2.9%. The two things that matter besides inflation expectations is consumer expectations. We're actually expecting those could fall from 68.8 to 68.2, and Michigan current conditions are expected to fall from 62.7 to 62.3. So actually expecting that these numbers are going to come down. Now, if they do, then markets might look at that and say, hey, was this retail sales data just a 1 month event? Is it gonna, get worse potentially? Because this data is for the month of August. The retail sales data that we just got yesterday was for July. That data will be important, but next week we really don't have anything as far as economic data of any kind of significance. Monday, you have CB leading index month over month. Tuesday, you have inflation out of Canada. You have Fed Bostic that speaks. Some balance of trade data out of Japan. Wednesday, you have, the FOMC minutes at 2 p.m. That's it. Thursday, you have initial jobless claims, Chicago Fed National Activity Index, continuing jobless claims, S&P Global Composite PMI, that's probably the biggest data of next week, Kansas Fed Manufacturing Index, Kansas Fed Composite Index, existing home sales month over month, and just for the month of July. But that's it. The Fed balance sheet will be coming out at 4:30. Nothing really of huge significance, not like this last week. Friday, you literally have nothing. You have new home sales for July and new home sales month over month. But that's it. So I'm not expecting much as far as, immediate downside in markets. And I'm not expecting much more upside for markets as well. I think we can trend higher until we get new information. Markets, just so you know, tend to follow the path of least resistance. So I think at this point, with the bounce we have seen, that is the path of least resistance. And we still have quite a bit of a way to go before the RSI is overbought again. The RSI is at 58.22. So sure, could you rally another 1 to 2% over the next, call it 8 trading days, 6 trading days or so? Sure, you could, definitely. I don't think that's a stretch at all. But did this data today really change my perspective on the economy about a hard or soft landing? No, it didn't. This was one data point, okay? There's many other data points that suggest the economy is weakening, and it's a fact. The economy is weakening. The question is just how much is it going to weaken versus expectations in markets. So if you're an equity investor, like if you're watching this video, I'm sure 99.9% of you are, then the question is, what is the actual growth going to be? Do we go into a recession? And what are the markets expecting? What are the markets pricing in? The markets are expecting a booming economy in 2025 based on EPS growth rates that are expected to be north of 15% for next year. EPS estimates for the S&P are at all-time highs. I mean, even with this 10% correction in markets, 2025 EPS didn't move, okay? So was it a growth scare? Kind of. It really wasn't a recession scare, though, okay? Now, if we head over the next couple of months into a slowing economy, maybe earnings become more challenged in the next quarter, then that's where you start to really get off sides on a risk to reward basis, with earnings estimates being essentially priced to perfection. As Warren Buffett says, you know, you will make a lot of money if you buy stocks that are trading at silly prices and you're correct in, you know, what you think the business is going to do, right? Just like that, to the downside, stocks sometimes trade at silly upside prices with silly, you know, forward expectations. And the expectations for earnings growth next year are silly, okay? They are priced for perfection. Even if they do come true, how much more upside is left, you know, to have earnings estimates go higher? Not that much. So whether or not we go into a recession or not, I think is a totally different question than do stocks, you know, go materially higher from here. And the only way you go materially higher from here is if you get multiple expansion, which that's kind of hard to see even if the Fed does cut rates, because you already have big tech that is trading at high valuations. You need to see some real, you know, M2 money supply growth, some more stimulative measures, less inflation, in my opinion, to get multiples go higher. You're pretty stretched on multiples. Earnings expectations are pretty stretched. Like, where does that upside actually come from? It's hard to tell at this point. You're not priced for a doomsday scenario. You're priced for perfection. Whereas it's not going to take much for the markets to say, maybe our estimates are too high for 2025. Maybe the economy does weaken further from here. So long story short, based on today's data, I know a lot of people want to jump ships if they were bearish yesterday or you know, bearish on the economy yesterday, and they want to say all is fine now because retail sales came in better than expected today. That's just not true. I think if you look at the markets different than the economy, that's kind of what the markets have been doing this whole time. The economy is not nearly as strong as the markets perceive it to be. And that's really because of earnings expectations and some of your mega caps that are driving that, right? There's other smaller reasons for this. But again, where does the upside come from in markets at this point? It's hard, okay? It's definitely hard. And if you were in the bullish camp, I think the S&P, it's hard to be super bullish on the S&P as far as any kind of material upside from here. But it's easy to be bullish on PayPal, on Tesla, on Dollar General, on CVS Health, on, CRISPR, or some of your quality small caps, right? Those are some of the names that I personally own and have been buying. Nike, for that matter, if the consumer does get a little bit better. I think the broadening out aspect of our markets would be the area to bet on, but that doesn't necessarily mean upside for the S&P if big tech does not participate. So I think some areas can do well in our markets. Some areas will not do as well, especially considering big tech has kind of been the reserve safety trade if we do go into recession. If we actually do have a soft landing, I don't think big tech will do nearly as well as it has been doing. Just like other years prior, big tech was never a huge outperformer compared to small caps or mid caps, right? Big tech actually underperformed small and mid cap stocks during normal markets most of the time. Specifically, mid caps tended to outperform big tech, again, because things don't move the needle all too often for big tech, right? They're heavily covered companies. $1 billion, for an example, doesn't move Microsoft the way it would move, a different company. So these are kind of my perspectives. I think there is very high expectations, and I don't think those expectations are correct. Even if they are correct, I still think there's limited upside, and I do think the risk is for downside. Now, if the economy does weaken further, then the markets will start to price that in. That's where you get equity downside. If the economy holds up and does okay, then I just think we could trade in a very volatile range with limited upside and limited downside, and likely start to form a broadening out of our markets over the next couple of months. And I think that also applies for Tesla. You will see that broadening out really affect Tesla in a positive way. We do have the Robotaxi event on October 10th. That's going to be the main catalyst for Tesla and might start to put Tesla on the AI radar. I still do believe at some point over the next, 12 months, there will be a shift from, your AI let's call it GPU providers, AI semiconductor providers, to your software companies, the companies that are actually using AI, building services and products around AI. And I think the hype will transfer from semiconductors to the applicable areas or applicable companies that are actually applying AI, which is Tesla to a T. So from that standpoint, there's a lot to love about Tesla, even at these prices. I think profitability is going to increase a lot in 2025, more than expected. That means the actual valuation of what you're buying Tesla stock for today is lower than what the numbers actually suggest. For an example, if the P multiple is, let's call it 60 today, then I think it could actually be 50. Based on what forward 12-month earnings will come in as. We also expect the Cybertruck will start to be profitable as well here over the next 1 to 2 quarters. Tesla, less interest rate buy downs are happening as 10-year treasury yields do fall. That is a direct correlation to profitability and many other things that are specifically helping Tesla right now, or will help Tesla over the coming, quarters, I don't think are very well reflected in Tesla stock. And then again, when you start to get some more optimism, some more hype around Tesla's AI prospects, that's where things get really exciting for Tesla. And then we're talking about new all-time highs. So I think a broadening out of our markets makes sense at this point. But I do think the S&P, the NASDAQ, if you will, on a headline basis, doesn't have much upside left. So if you're an index fund investor, that doesn't sound great. If you're a stock picker, that sounds really good. So let me know what you think about this information down below in the comment section. Again, it's going to be volatile. I don't think one data point should really change your opinion on hard or soft landing. I do think, my personal opinion, I have 30+% cash still on the sidelines. Yes, I did buy some CVS Health. I bought some more Dollar General. I bought some Nike. These are companies that pay 2 to 4.5% dividends. I do think something like a CVS Health is pretty capped on the downside because it's paying 4.5%. 10-year treasury yields are now under 4%. As the Fed starts to cut rates, I also think there will be more valuation support for some of these dividend payers that have safe dividends, right? CVS Health's dividend is pretty safe at this point, and I think there can be share price appreciation with those companies, because obviously as the share price goes up, the dividend yield falls. So as the Fed lowers rates, I think the dividend yield will fall on high quality dividend companies that are paying more than the federal funds rate, and that means the share prices of those companies will go higher. Just to kind of keep things simple here, cash is king still. Today really doesn't change anything about my longer term thesis on the economy. I do think it makes the case for a broadening out market a little bit more appropriate, but I do think big tech and the headline S&P is pretty close to capped out on upside. I do think Tesla looks attractive at today's prices. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.